Welcome to NRVP's webinar on opportunities to generate cash and reduce federal taxes in the wake of the CARES Act. I'm Barbara Kaufman, Executive Vice President and COO at Newark Regional Business Partnership. I will be doing a brief introduction, which includes an overview of what we'll be doing today. But first, I'm going to cover some of the other events, virtual events, that we have coming up. The first are some logistics. All of you are muted and do not appear on the camera. There is a question box, and if you have questions, and just Michael and Sara, while I'm giving the instructions, you just mute yourselves. That would be helpful. So there is a question box, and if you have questions, please put them there. We're going to be holding all questions until the end, and at the end I will be directing the questions to our presenters. One question that always comes up is whether the presentation will be available after the program, and the good news is yes, our presenters are willing to share the presentation, so there will be a PDF attached to your thank you for attending email. There is also a chat box, and Maya Curry, our communications director, will be putting notes in there if there's anything that is either a reference or something that attendees want to be aware of. So watch your chat box, and there'll be information there that's valuable to any references that are mentioned, etc. We'll be going for about 40 minutes, and then we will turn to questions. At the end of the questions, Chip Halleck, our President and CEO, will join us to wrap things up. So that's the format for today. Upcoming, yesterday, some of you were on the call that we had with Peter Bronsnick, who is the President and CEO of SJP Properties, and we had a really great conversation with him. What we've done, we're continuing to evolve our webinars and our networking virtual events, and what we did this time was we asked each attendee to introduce themselves and to say something about what they do, as well as anything where NRVP or other attendees can be helpful. And it ended up being a very interactive conversation. So I hope that you will join us next Tuesday. Our guest networker next Tuesday will be Adina Bio. Some of you may have heard her speak at our real estate market forecast. She is unique in that she is developing affordable housing in downtown, and she has a wonderful philosophy about being able to bring together different income levels in a development, and a really great philosophy about redevelopment and development in Newark. She's also the owner of several restaurants, including her own brand, Cornbread. It's a great opportunity for anyone who provides services, anyone in the construction industry. This is an opportunity to talk to a CEO who is on the move and growing. Then on Wednesday, we have about 10% of our membership are nonprofit organizations, and we have a very special opportunity on Wednesday. We'll be looking at finding funding, ways to be able to work in the virtual world. Many nonprofits are suffering greatly because their planned in-person events had to be canceled, and this will be an opportunity to learn some tips about how to raise money virtually. And we'll be hearing from Impact Consulting Enterprises, Cheryl McCants, on that. So that's Tuesday. I skipped over tomorrow. Tomorrow is our happy hour with a new brewery coming to Newark Local Beer. They will be at the Walker House in the former Verizon building. That should be a lot of fun. So join us, relax a little bit, and for that, as well as in the Nexus programs, we're inviting everyone to introduce themselves and do some virtual networking. It's the best we can do compared to being able to be together in person. And finally, our happy hour next Thursday will be with Ironbound Hard Cider. And Charles Rosen is doing some pretty unique things with farm to table and with growing his own products and crops, including the apples that are used in Ironbound Hard Cider. So that should be a lot of fun too. So with that, I'm going to turn to our speakers. While the presentation is going on, we'll have our cameras off. We'll turn our cameras back on when it comes to Q&A. I am going to mute myself momentarily and remind the speakers to turn their speakers back on so we can hear them. And very, very much look forward to this presentation. I'm quite excited to be able to offer Sara Holland and Michael Grace. They will provide introductions about what they do at Lewis Brisbois. Thanks so much. Sara, your microphone's still off. Still muted.
Okay. Hi, everybody.
There we go.
Can you hear me? I think you can. Welcome. Thank you very much for joining us this afternoon to the updated CARES Act tax webinar. We will also be discussing the newly minted PPP Flexibility Act that was just signed into law last week. Over the next 40 or 45 minutes or so, my colleague Michael Grace and I will make efficient use of your time by covering the cash generating and tax savings opportunities for businesses, as well as we will highlight several best practices measures under the CARES Act and the PPP Flexibility Act. Before we dive into our checklist and our content, a few words about Michael Grace and me. Michael Grace is our most senior member of the Lewis Brisbois Tax Practice Group and is also a CPA. Before joining our Lewis Brisbois, Washington, D.C. office, Michael worked in the National Office of the Internal Revenue Service. And I am Sara Holland. I hold an LLM in tax, and I work primarily in the Newark, New Jersey, and sometimes the New York City office of Lewis Brisbois. And for those of you on the call who are located in and around Newark, our office is at 1 Riverfront Plaza, not far from Newark Penn Station. Okay, so now on to our checklist. So what Michael and I compiled was a real-time CARES Act checklist that we invite all of you, particularly business owners, accountants, attorneys, to bear in mind as you take a look at what opportunities you might have with respect to cash generating and tax saving benefits under these laws that are partially explained by the Department of Treasury, but a lot of guidance is still on its way. So the first item on our checklist is the PPP Flexibility Act. This is the Payroll Protection Plan Act, and it has added flexibility to both the timeframes and the uses of PPP funds. From there, we're going to discuss the lower taxable income that business owners can enjoy and take advantage of by virtue of the increased business interest expense deductions that are allowed under the CARES Act. And then from there, we're going to discuss the carryback net operating losses that are now available to be used as far back as 2013 and 2014, and this can potentially generate tax refunds. From there, we're going to discuss the deduction of non-corporate excess business losses that go as far back as 2018. We will discuss the accelerated AMT credits the write-off of tenant improvements as far back as 2018, the deferral of federal employment taxes, or some of them, the ability to take advantage of employee retention credits against payroll taxes, and that's something that has been in existence and we'll go over again. And then there's a 50% reimbursement credit that is available to reimbursing employers. And for those of you listening who represent nonprofits or work at nonprofits, this may be of particular interest to you, and that pertains to the payment or reimbursement for state unemployment benefits. Finally, we have a couple of employment-related tax measures, the amended tax qualified defined contribution plans that now allow for the temporary waiver of required minimum distributions. And then finally, the amended retirement plans that we recommend you consider to allow for the temporary waiver of early withdrawal penalty for COVID-19 related distributions from retirement accounts. Michael, I believe you had some additional thoughts before we move on. Michael?
I'm sorry. And when I say we, Sara and myself, and I think the chamber, we're all aware of what we've heard about webinar fatigue. I think with all this staying at home, people have seen and had a lot of webinars, but we're going to try to make your time valuable here in a couple of ways. One is we've deliberately limited the time of this, which means that we're really just going to hit the highlights and try to give you some ideas that you can, from which you can profit. And I just wanted to mention just a couple of things for businesses. That is, for those of you who are listening who work in businesses, the CARES Act has evolved where the PPP, the Payroll Protection Program, has attracted a lot of the attention. But we need to remind ourselves that the CARES Act also provided these tax changes that are designed to help businesses conserve cash, and in some cases generate cash, in some cases by claiming from the IRS refunds of taxes previously paid. So we'll try to highlight those, if for no other reason, to remind you of those opportunities. And for those of you who are tax professionals, I just want to share with you that we are working in the tax field in unusual, even unprecedented times. We see that the IRS and the Treasury are continuing to work. They're like most of us. They're working remotely, and they are actually continuing to issue some regulations. But for the most part, that is IRS and Treasury, have been interpreting the new rules in the CARES Act primarily by posting on the IRS's website notices, some revenue procedures, but a lot of FAQs. And it's important in this environment, if you're in the tax field, tax professional, to check the IRS website, www.irs.gov, frequently, if not daily, and specifically under the tab Get Coronavirus Tax Relief, because, I mean, it's almost like the IRS on steroids. This is their main outlet right now for sharing guidance, and has been coming fast and furious. So I would just, if you're a tax professional, commend that to you. But with those thoughts, Sara, why don't we try to update everybody on what's going on with the PPP program, especially this new legislation?
Terrific, Michael. Thanks. Okay, so let's just take 30 seconds and by way of background, just bring everybody up to speed on what the Paycheck Protection Program, the PPP loan forgiveness program is. This is a loan forgiveness program that is available to small businesses with 500 or less employees, or to businesses that qualify under SBA alternative size standards and that have greater than 500 employees. This alternative test is industry specific. So the CARES Act allows the recipient, a borrower of a covered loan, to qualify to have all or some of that loan principal forgiven. So that's really the magic of this loan from an economic sense. So the loan generally can be forgiven to the extent that the borrower uses the loan to pay for what are called eligible expenses. Now, the Flexibility Act has made some very significant changes to how this loan program functions, as Michael was alluding to. So prior to the Flexibility Act, the loan amount was designed to cover an 8-week covered period, meaning the loan amount would be equivalent to the eligible expenses payable over an 8-week covered period, and that loan amount would in fact have to be spent during that 8-week covered period. The Flexibility Act was passed in part to expand that time frame because a lot of our small businesses just aren't ready to stand up on their feet after 8 weeks. So now that covered period is 24 weeks instead of 8 weeks. So it is now 6 months essentially instead of 2 months. And that is a big change. So what we can tell you so far, and as I think you've gathered from what Michael has covered, the Department of Treasury still needs to issue guidance around what this 24-week covered period means for the borrower. What we believe the intention is that not only will the borrower now have 24 weeks to spend the eligible expenses or pay for those eligible expenses, but the loan amount can now match the equivalent of what the eligible expenses are for a 24-week period versus an 8-week period. So that obviously means that we believe the intent is for borrowers to have more access to these forgivable loans. So what are the eligible expenses? We can cover that quickly. So you may be aware, but just to go over, these are payroll costs. These are interest on covered mortgage obligations, covered rent obligations, and covered utility payments. So basically, in the interest of time, I'm just going to move to this slide. So this is very important to highlight. Under the CARES Act, the borrower was required to spend 75% of the loan on payroll costs and only 25% on non-payroll costs. Well, the Flexibility Act has changed that ratio to allow for more flexibility. So now instead of a 75-25 ratio, it is now a 60-40 ratio. And what that means is borrowers only need to spend up to 60% of the loan on payroll costs and 40% on non-payroll costs, which would give the borrower more flexibility, especially relative to expenses such as high rent. And this is something that we ask all of the listeners to bear in mind, because if you have exhausted your 8-week period, loan applications for the PPP loan, the deadline does remain June 30th of this year. But again, we believe the intent is for the lenders to potentially make loan amounts granted for these additional 16 weeks, and that the SBA could approve of that additional loan amount. So please bear that in mind. Michael, do you have anything to add to this?
No, I would just point out that yesterday, June 8th, the Treasury Department and the SBA jointly issued a press release, basically saying that we're proud of ourselves for pushing through the PPP Flexibility Act, but we're also aware that there's remaining questions. So they have committed, and I'll just read this: will promptly issue rules and guidance, a modified borrower application form, and a modified loan forgiveness application. So if you're angling to borrow a PPP or an additional PPP, I think what you should do is get with your lender, have the lender coordinate with the SBA, and be ready to pull the trigger as soon as these updated forms come out. And it sounds like they're due any time now.
That's great, Michael. That's very helpful. Thank you. Okay, so of course we have a lot more ground to cover. So our next topic under this CARES Act and Flexibility Act update are the increases in business interest expense limitations. So before the CARES Act, and by way of background, small businesses, and so if this applies to you, just be mindful, small businesses that earn annual gross receipts averaging less than $25 million are exempt from this limitation entirely. And that also includes or expands to real property, trades, or businesses. That would include development, construction, acquisition, rental, or those sorts of related real property businesses. But for those businesses that are subject to the business interest expense limitations, this is what the CARES Act has done. The CARES Act has temporarily increased from 30% to 50% of adjusted taxable income the amount of business interest expense that is deductible. This temporarily increased limitation applies for tax years beginning in either 2019 or 2020. Under the CARES Act, a taxpayer may elect to use its taxable income from 2019 instead of 2020 to calculate its deduction, which can be beneficial because unfortunately a lot of our businesses saw higher income in 2019 versus what they are expected to earn in 2020 because of the economic effects of the COVID-19 pandemic. So a business owner, likewise, may decide to stay with the 30% limitation rather than take advantage of that 50% limitation for 2019 and or 2020 if the business owner anticipates that its business income will increase in future years. So this is a tax accounting consideration. So we invite you to bring in your experts and make the best choice that you can for your business. For partnerships, at the entity level, a partnership can elect out of that 50% limitation and instead apply the 30% limitation for 2020, but not 2019. And partners may elect out of the 50% limitation for 2020, or if the partner later changes his or her mind, he or she can revoke that election. Michael, do you have anything to add with respect to the business interest expense limitations?
Only to point out that the devil can be in the details, because if you look at some of this guidance that I referred to earlier that you can find on the IRS website, they've issued a revenue procedure that details all these different choices and elections that can be made. You know, use the 50%, stick with the 30%, use the 2019 instead of 2020, elect in, elect out, and you almost have to draw yourself a decision tree. So this is a great opportunity for tax professionals to educate their clients on the different choices. But at the end of the day, really to figure out how best to avail yourselves of these changes to the business interest expense, you really have to sit down and run the numbers and compare scenarios.
I couldn't agree more, Michael. That it really is. It can be Byzantine, and it really is important and worthwhile to round up the experts to help. So our next checklist item relates to the treatment of net operating losses under the CARES Act. Just by way of quick background, a corporation or other business realizes a net operating loss, or an NOL, when its tax deductions exceed its taxable gross income. So in general, prior to the CARES Act, taxpayers have been allowed to carry over NOLs and deduct them from future years' net income until the NOLs were fully used, usually limited to 80% of taxable income, and then NOLs were allowed to be carried back in prior years, but not recently. So in order to ease tax burdens on businesses, the CARES Act provides two opportunities that enhance the deductibility of NOL. First, NOL carrybacks and carryovers to a tax year may offset 100% of that year's taxable income rather than be limited to that that usual 80%. And this temporary change applies to tax year 2020. And then secondly, NOLs from tax years 2018, 2019, and 2020 must be carried back up to 5 years unless the taxpayer elects otherwise. Any NOLs from these years not absorbed by carrying them back will carry over, and if a taxpayer elects not to carry back NOLs, then the NOLs solely carry over. So here's the major cash-generating benefit with these changes under the CARES Act to NOLs. And this applies to when NOLs are carried back to tax years 2013 to 2017. As many of us recall, prior to the Tax Cuts and Jobs Act of 2017, the corporate tax rate was 35%, as opposed to the 21% corporate tax rate that went into effect in 2018 pursuant to the Tax Cuts and Jobs Act. So the fastest way for a business to carry back NOLs and to claim refunds is to, I'll stay on this one, I apologize. The fastest way to carry back these NOLs and claim the refunds and harvest those refunds from those earlier tax years that were at a higher 35% corporate tax rate is to file what's called a quickie claim for this sort of refund. Corporations should file what's called Form 1139, and this is not a one-size-fits-all decision as to how to best harvest these NOL loss carryback claims. But again, this is something that a tax professional can help you navigate. Michael, do you have anything to add to our NOL coverage?
I'll simply repeat the same thing I said about the business interest limitation. It's not, as you say, Sarah, one size fits all. In deciding what to do with NOLs if you have them, deciding to stick with just carrying them forward or carry them back, it's really a matter of sitting down with a piece of paper and running the numbers and comparing scenarios. That's the only way to figure out what the best result is. But if you do decide to carry back, as Sara says, the fastest way is to file one of these quickie refund claims. The IRS by law must process the claim for refund within 90 days of receiving it, although it can always audit a refund that is issued later. But the quickie refund claim is the way to go. And even with the IRS closed, they're now accepting those by fax. So that's helpful as well.
Oh, that's great. Okay, thank you, Michael. Okay, so Michael, I'm going to turn this topic over, modified limitation on deducting business losses of non-corporate taxpayers.
Yes, thank you, Sara. And this harkens back again to the Tax Cuts and Jobs Act of 2017 that imposed this new limitation on non-corporate taxpayers being able to deduct what they called excess business losses. It's really the amount by which business deductions exceed business income or gains, plus $250,000 cushion or $500,000 for married taxpayers filing jointly. And that limitation under the TCJA 2017, everybody thought, well, that's going to start applying in 2018. So you have a lot of taxpayers out there who impose that limitation in filing their returns for 2018, maybe even for 2019 if they've already filed. But then the CARES Act comes along and says, no, we're going to postpone this until 2021. Well, what does that mean? A couple things. Number one, it doesn't apply for 2020, so you don't have to worry about it this year. And if you applied it for prior year returns, 2018 and or 2019, you can now go back and file amended returns and claim a refund. So this is like the NOLs. It's a refund generating opportunity. And so that's the main thing about that, Sara, unless there's anything you want to add.
No, and I just echo everything you said on that topic. I know in the interest of time, we want to make sure we get to everything. So I thought we would move on to AMT credits.
Yeah. So let's go to this. So this AMT credits. Now this is of interest to corporations, and this gets a little. I love Sara's word Byzantine. It gets a little Byzantine in that TCJA repealed the alternative minimum tax effective after 2017, but provided kind of as a legacy matter, a refundable AMT credit. And that was supposed to be taken over several years from 2018 through 2021. So everybody thought, well, we have to parse these out over 2018, 4 years, 18, 19, 20, and 21. CARES Act comes along and says, look, here's a way to try to generate some additional cash for corporations. So we're going to accelerate the ability to take those remaining AMT credits. So under the CARES Act, one opportunity is corporations can just take the remaining amounts entirely in 2020 instead of the remaining amounts over 2020 and 2021. But there's even a better opportunity. Let's say you have unused AMT credits. You can actually elect to take it all the way back to 2018 and amend returns and claim refunds from the IRS. So this is another one of the situations where what you do depends on running the numbers, but it's a cash generating opportunity for corporations. And then the next thing, go ahead, sir.
I was just going to add, as I'm listening to you, and I know we've discussed this before, but it's very interesting how the CARES Act has provided these different offshoots, and it can certainly be confusing, but it does give options, which I think it was well intended. It wasn't intended to be confusing. It was intended to provide options, so it's not a one-size-fits-all sort of amendment, and you're pointing that out.
Thank you. All right, so now we're going to shift. We've been talking about federal income tax and cash generating and saving opportunities for federal income tax. We're now going to shift to federal employment or payroll taxes. And a couple significant benefits in the CARES Act. One is to defer some federal employment taxes for 2020. We get a huge number of questions about this, and there's been a new development under the PPP Flexibility Act that we'll mention. But just to talk about the basics first, any employer of any size can do this. The taxes can be deferred are those from March 27 through December 31, 2020. Now, you may be saying, what in the world is March 27? Well, that was the enactment date of the CARES Act. Here's the taxes you can defer. The employer, the slide, by the way, says employee, so change that on your slide if you would, folks. Employer share of OASDI portion of FICA, or 6.2% of wages. Self-employed people can take 50%, or the equivalent to 6.2% of their self-employment tax. They can defer that. Now, it's important to remember what cannot be deferred. No part of the employee's share of FICA can be deferred. Now, footnote, Larry Kudlow and other people in the White House keep talking about a payroll tax holiday or deferral for the employee's share. That has not yet happened. So this just applies to the employer share. And similarly, the HI portion of the 1.45% of wages cannot be deferred. So you say it's deferred. Okay, so when do you have to pay them? Well, you don't pay them currently during 2020. You wait until the end of 2021 and pay in half of it by December 31, 2021, and the other half by 2031, 2022. So you get basically 2 years split 50-50 to defer these taxes. So if we can go to the next slide. And this is what I want to talk about with the CARES Act and the new legislation. This is very exciting. The CARES Act put borrowers to a choice. Either take out a PPP loan and qualify to have it forgiven, or defer these federal payroll taxes, but not both. You had to choose between the two. PPP Flexibility Act comes along, decouples that. It says, look, it doesn't matter whether you have your PPP forgiven or when, you can qualify to defer these federal payroll taxes. So that's a very taxpayer favorable result, applies retroactively to the beginning of the PPP program. So we can go to the next slide. And as I said, this just repeats what I said, when the deferred amounts have to be paid. All right. and then the next thing I think, Sara, is, and yeah, and we basically already covered that, so let's just move along. Yeah, just keep going. All right. The other one, and in the interest of time, I'm just going to mention.
Okay, yeah. Please go ahead.
Employee retention credit. This is, again, federal payroll taxes, employment taxes. It's a refundable payroll tax credit, 50% of wages paid to each employee, up to $5,000 per employee. It can be taken as long as you can demonstrate that your business suffered adverse effects from the coronavirus, and they're listed there on the slides. Important to note, though, if you're a tax-exempt organization, you can take this credit whether or not you've suffered those consequences. And this does remain coupled with the PPP, in that if you take out a PPP loan, you cannot take this credit. So that choice does remain in place. Sara, I think you had a footnote about a variation for nonprofit clients.
Yes, thank you, Michael. So this is something that I'm seeing in real time with actually one of our nonprofit clients. And here's the big picture. This nonprofit client took out a PPP loan. That loan coverage period ended last Friday. And because of COVID, they are unable to keep their employees because they're losing 75% of their revenue. They run outdoor recreational programs, and they're just losing revenue this year. So they're laying off 15 employees. And because they are a nonprofit, they are a reimbursing employer, meaning they're not paying that monthly unemployment benefit insurance to the state. Rather, they pay it once their employees actually apply for unemployment. So the question was, what do we do? We're laying off employees because we can't afford to pay them, but then once they're laid off, they're going to claim unemployment, and we're not going to be able to reimburse the state. So what this CARES Act provision allows or provides is a 50% credit. So basically how it plays out is you have a nonprofit employer or a reimbursing employer with laid off employees. They make an application for unemployment benefits, let's say in June. In July, the employer will get a statement of benefits. In August, they get an invoice from the state, reimburse us for this amount. The nonprofit employer on that first invoice will have to pay a full 100%, but then moving forward on that next invoice in September, that employer will see a 50% credit from what they paid in August to offset their September invoice, and so on. And that's how this 50% credit is designed to help these carrying costs for reimbursing employers. It sunsets December 31st, 2020. So that's something, especially if you're a nonprofit, to bear in mind. So next, Michael, I don't know if you wanted to discuss minimum distributions, or if you wanted me to cover this, but whichever you prefer.
Let's just, we can spend a few minutes on this because I think we still have time before our question and answer session opens. And just to put this in context, the next two subjects involve distributions from qualified retirement accounts, that is IRAs, 401ks. And this primarily affects the tax consequences of the recipient, okay? But we want to cover here because it's an important opportunity for employers, if nothing else, as a matter of public relations. The first one is that for calendar year 2020, the CARES Act waives all requirements to take RMDs or required minimum distribution from qualified plans, even for people who have already started taking RMDs. So it's basically a one-year holiday for everyone. And how does that affect the employer? Well, the CARES Act also says, look, if you want to amend your plan to make it clear that the RMD doesn't have to be taken in 2020, you can amend your plan without violating ERISA or any other very technical foot faults that can afflict a retirement plan. And then the other opportunity under the CARES Act is that for 2020, qualified individuals can take $100,000, up to $100,000, out of a qualified plan, like a 401k, without it being subject to the 10% early withdrawal penalty. So let's say you're like, 45 years old or something, but you want some extra cash, you can take it out without being subject to the normal 10% early withdrawal penalty. You have to satisfy certain qualifications to prove that you were affected by the coronavirus, and they're on the slide that you can read. I just want to point out the distribution is potentially subject to federal income tax, but not if within 3 years of receiving it, the recipient recontributes the distribution to one or more qualified plans, and you can do that in installments. So let's say you took out $100,000 from a single plan, you could put $50,000 into another plan and $50,000 into a third plan and still qualify. So that's a great benefit. And again, employers without violating ERISA can amend their plans to provide for these distributions free of the early withdrawal penalty. I simply want now to put a coda on some of the things we've been discussing, particularly some of the things that Sara has mentioned, and just mention a couple things. First of all, we've been talking about the PPPs and qualifying for them to be forgiven. Basically, when you have a PPP forgiven, that in effect converts it from a loan to a grant because you don't have to repay it. Questions have arisen about the income tax consequences of that. So let's say you take out a PPP and it's forgiven. Well, tax lawyers know that typically if you have a loan forgiven, that's called cancellation of indebtedness or COD income that generally has to be taxable, subject to some existing exceptions. But under the CARES Act, the forgiveness of the PPP qualifies to be excluded from COD income, so that's a great benefit. Now, question has come up. People say, well, wait a minute. I know that I've used this PPP to make these qualifying expenditures like payroll, interest on mortgages, et cetera. Generally speaking, those kinds of expenses are deductible for income tax purposes. Are they deductible in this case? And there's competing schools of thought on that. The IRS has come out and said they're not deductible because the forgiven amount is excluded from gross income, and to give people both an exclusion and a tax deduction would impermissibly give them a double benefit. So that's the IRS's current position, and that's what they're administering. But there have been bills introduced in Congress to reverse that, basically preserve the exclusion of the COD and allow the expenses to be deductible. As of today, there's a lot of wishful thinking, but no actual legislation on that. And the other thing I would mention is there's a question mark here. Is there going to be more federal stimulus legislation? It's a question mark. Some weeks ago, the House of Representatives passed the HEROES Act, declared to be dead on arrival by the White House and the Republicans in the U.S. Senate. What, if anything, will happen next? Nobody knows. I would commend to you, I'm looking at today's Wall Street Journal, Wednesday, June 10, 2020, page A3. I'm old-fashioned, I get it in print. But, there's two competing articles. One is about ending the extra $600 unemployment compensation that the CARES Act provided when it expires July 31. The other is the White House says it supports more stimulus legislation. So you take your pick as to what may or may not happen. And so that's my advice to you, Sara, and everybody else.
Yes. Well put for sure. It's interesting how the PPP loan delivers an economic benefit, and now the question is, will it also deliver this tax benefit as well? So that will definitely be something that we're going to keep an eye on. Is there anything, I don't know, Barbara, how we're doing on time, if we're going to have time to cover qualified improvement property and some additional topics, or if we're opening the questions.
Well, Sara, why don't we, I'll tell you, I have one question that I can ask now, and then we can continue a little bit longer if there are no other questions that are posed in the question box. And I actually just wanted to make one point too, but the question that's posed is that businesses that already received the PPP loan eligible, under the first round, had the shorter time period. So the question was, the way this is worded is, would they be eligible for an additional PPP loan for the 16 weeks? And I would also read into that that they might also wonder whether, with their first loan, if it would be extended to the 16 weeks from their original date because of this change, or if it's just that it's a different bucket and therefore they're restricted to what was originally promulgated.
Okay, thank you, Barbara, very much. That's a really great question, because I know that the PPP loan and this Flexibility Act and how it expands the loan availability is something that is applicable to probably a lot of our listeners. So, as we said from the outset, we want to be careful, and Michael and I talked about this just in terms of distinguishing between intent versus what the actual guidance says on these particular questions. So the best we can do for now, Barbara, and for our listeners, is to offer what we understand to be the intent of these changes to the PPP loan program. But until the Department of Treasury actually issues guidance, we don't know with 100% certainty. So we're all kind of treading these new waters together. So we take the 24-week period expansion to mean that a current borrower who has a loan amount that was intended to cover 8 weeks worth of covered expenses can now spend that money across a 24-week period, and it's not held to the 8-week period, and that is in step with the ratio shift from 75-25 payroll costs to 60-40 payroll costs. So it allows that flexibility, that needed flexibility, so that the borrowers can be in step with that new ratio. But what we also take this to mean, and with the PPP loan application deadline still at June 30th, which is fastly approaching, it does allow either brand new borrowers to apply for a loan that is intended to cover for that 24-week period and have that same amount of time to spend those funds. Or if you are an existing borrower and you've had the benefit of that 8-week covered period loan, you now have an opportunity between now and June 30th to apply for a PP loan application, to apply for an additional 16-week period that would in total bring you to 24 weeks. So it's really up to the lender understanding what those 16-week eligible expenses look like, and then it's up to the SBA to approve these loans, and so that's our interpretation. Michael, what do you have to add to that?
I would echo those thoughts. Subject to the caveat that we're awaiting this hopefully quick additional guidance. But I would just emphasize 3 points. One is the intent of the PPP Flexibility Act was to put to give PPP borrowers more time to get their businesses back on their feet. So I don't think that the SBA or the Treasury plans to interpret the rules in a way that would conflict with that overall legislative intent. I would also point out that the Treasury Department has confirmed in this press release from yesterday that the deadline remains June 30, 2020, but there's no sense that there's just one shot at the apple. In other words, just because you've already obtained one PPP loan does not, by any terms in the legislation, prevent you from getting another one if you need the additional funds and you need the additional 16 weeks or whatever. And the last point I would make is this is more of a technical argument, but the PPP Flexibility Act, with one exception, specifically all aspects of it were retroactive to the effective date of the CARES Act. So I think it intended to carry out and continue the intent of the CARES Act. The one exception is the maturity date of the loan. The original maturity dates under the CARES Act were 2 years. If you obtained a new loan on or after June 5, then your maturity date is instead 5 years. That's the only part of this new Flexibility Act that is prospective only. Everything else is retroactive, and I think is intended to carry out the intent of the CARES Act, but with a longer runway or ramp up from the 8 weeks to the 24 weeks.
Yep.
All right. I think with the and that was, thank you. Hopefully that answers the question that the asker had posed. If there's anything further to the people listening, please put it into the question box. I do think it probably would be good to start to wrap up because we are near the 3 o'clock hour. So I think maybe just show your final slide, and then we'll turn off the presentation and turn the cameras back on. Okay.
Sure, thank you.
And yeah, just was going to say, Sara, that we will be making this presentation available, and Sara and Michael both have put their information up there. I do actually have another question for you and a comment first, and that is that we have a number of banks that have been working very, very hard on PPP and CARES Act. So I know that the bankers, and it happens that we have several people from MTB Bank on this call, and MTB has been one of the most active banks in terms of assisting their clients. So I would think that bankers are one source of assistance, but all of this is so complicated, and I'm wondering when someone, because business owner, first of all, they're struggling to figure out how to run their business, and if they're reopening, what's a safe way to reopen, and then to have to think about all of this and to try to find the right roadmap might seem overwhelming. So I'm just wondering, which type of advisor is the best place to start? Is it with your attorney, your accountant, your banker?
Well, this is Michael. Let me answer that based on our particular law firm's experience. We very quickly, as the CARES Act was taking shape, formed a COVID-19 response team specifically designed to help clients and prospective clients understand all these changes, because as you point out, Barbara, they are very complicated, remain very complicated. But I think the way things have evolved for our law firm is that we have taken the lead in advising clients about how these rules work and just answering questions like the one that was posed. I mean, the question that was posed a few minutes ago is not unlike one that we hear in our practice every day. So our role has been to help clients understand, give them our best judgment, but then connect them with lenders who frankly are much better at processing these loans than lawyers are. I mean, we're just not good at filling out loan applications and SBA forms and things like that. So what we tend to do is position the clients to apply for the PPP loans, and then we funnel them to any number of lenders with whom we have relationships.
Okay. Sara, anything to add to that?
Thank you, Barbara. I would just quickly add, not only echoing Michael's advice, but in the interest of being cost efficient, sometimes, and understandably so, employers, small business employers, are trying to rein in their costs, and they don't want to have too large of a team and overstaff these, who they need to have around them to navigate these issues. I would ask our listeners and business owners in particular to remember that we really all are very mindful of what we know and what we don't know. So understand that you can have a banker, an accountant, and a lawyer at the table, and that's not going to triple your costs. It will hopefully lower your costs overall because you'll be more efficient, more informed, and you will use each of your experts to put us to our best use and our most discreet use. And I think that will serve everybody the best in the end.
All right. Thank you so much from me and from everyone on the call and all of us in NRBP. I'm going to turn to Chip and invite him to come on camera and close out today's webinar. Chip, are you there? Maybe he's having a little difficulty turning on his camera.
Hi, Barbara. This is Maya. Chip is actually accessing by phone, and he may be having an issue unmuting. I just sent him an unmute request, so I guess just give him an additional second to come through.
Okay. All right. If not, I will. I'll close out. I'll give him a minute. Okay. Well, in the interest of time, because it is 3 o'clock, what Chip would normally do is thank our presenters again, Louis Brisbois, Michael, and Sara, for providing such a thorough and effective, well-presented session with so much information that's valuable. I think for both our smaller businesses and our nonprofits in particular, this was great. Hopefully for some of the bankers who are on the line too, that was helpful. And we encourage everyone to contact NRBP if you need to be connected to a professional. We're happy to do that. Just as a reminder for those who may have joined the call after I did the opening, for tomorrow we have our happy hour with Newark Local Beer. Next Tuesday, our networking session with Adina Bio, who's a developer. Wednesday is our Finding Funding for Nonprofits. And Thursday is happy hour with Ironbound Hard Cider. So make sure you sign on for our networking, take advantage of being able to introduce yourself and talk about what you need. And please recommend these webinars to others. We hope that you will continue to join us for webinars despite all of us feeling a little bit of webinar fatigue. So with that, absolutely, we all do. So with that, I wish you a good day, and we're happy to have had you here. Thank you again to Sara and to Michael.
And thank you, Barbara, and to all who have listened.
Yes, likewise.
Right.
Thank you.
Bye.